Welcome to the Tradespotting video on the Bitcoin halving and the coming mining massacre. What is the Bitcoin halving and how do we trade it? Are there lessons from other assets that we can steal to bag the big bucks in Bitcoin? Many people think that the halving, essentially a reduction in production, will lead to an increase in price. Many people think that this quantitative hardening of Bitcoin, alongside the current quantitative easing of fiat currencies, will draw in lots of new investors. But without scrutiny, this is just an ideology, and we don't live in a world of ideologies. We live in a world of business. So whether you're trading the Bitcoin halving, your granny, or the apocalypse, it makes sense to test your theories in the real world. And that's what we're going to do today. Do you ever wonder how commodity producers or traders are able to get so stonking rich even when the price of the assets they're trading is dropping? Isn't it fascinating? For example, oil. Why are we sucking it out of the ground where it's safely and freshly stored in order to pay other people to take delivery for it? How can a rational, sane person look at that market and understand why the price of this asset has dropped to below zero and the people who own it still continue to produce it? We are taught through experience that you have to pay for the things that you want. People don't generally pay us to take from them. People who sell us things want as much money as they can get, and they'd like it now or sooner. The purpose of money is generally understood to be as a method of exchange, and this is how most people learn about and understand economics and money. But the purpose of money isn't merely as a method of exchange, it's also to centralize power. The problem with power derived from money is that it's only temporary. It is by controlling cash flow that true power lasts. So you can see that making money is one thing, but capturing market share and making money forever is much more important to a particular type of person. Here at Tradespotting, where dreams and goals meet ends and means, we're going to explain the Bitcoin halving. We're going to also explain negative prices in commodity markets, and not only why they make sense, but why they're deliberate, and how we can trade these events to make money. Understanding the halving is actually quite simple, and I'll explain it in just a few sentences. But trading it profitably requires deliberate thinking. There are many different dynamics at play, and the timing and direction of the moves will surprise many who don't have an understanding of the bigger picture. I'm going to go out on a limb and say you probably already understand that Bitcoin isn't made by the birds and the bees, delivered in a pelican's mouth, or made when two people love each other very much. Bitcoin is a reward to people who solve maths questions. It might be a currency, it might be a commodity, it might be a security. That's all debatable. But it's definitely a reward. These rewards are given to miners who solve maths questions. These questions are solved around every 10 minutes, creating a new block in a chain that stretches all the way back to the first block ever created. The miners who complete these questions, solve these sums, and create these blocks are rewarded with 12.5 Bitcoin. If and when the amount of computing power mining Bitcoin leads these sums to take less than 10 minutes to solve, then the difficulty of them is adjusted so that it takes 10 minutes again. This difficulty adjustment is at the core of Bitcoin to ensure that no matter how many people or how many computers are mining Bitcoin, that production remains at a steady rate. Every 2 weeks, this difficulty is assessed and adjusted to ensure that no more than one block is created every 10 minutes. So Bitcoin's a reward. There's only ever going to be 21 million of these rewards given out. The security of the blockchain, the finite supply of Bitcoin, and its constant production rate means that it has a predictable rate of inflation. The security of the blockchain, the finite supply of Bitcoin, and its predictable inflation rate are the reasons why people invest in Bitcoin. With 12.5 of these rewards given out every 10 minutes, that means before the halving, 1,800 new Bitcoin are produced every day. After the halving, there will only be 900 produced every day. Many people who mine Bitcoin will need to sell some in order to cover their costs. It's a relatively new asset with world-changing potential and has huge spikes in volatility. Now you know why it's sold, bought, and traded. So you understand Bitcoin and the halving. You might even think you understand price action to follow. A reduction in the production of Bitcoin without a change in demand will lead the price to increase, right? That may well be the case, but hold that thought and consider this. It also costs money to produce oil. The International Energy Agency says that it costs Saudi Arabia approximately $85 per barrel. How to explain then, with demand for oil at historic lows and prices down there keeping them company, that Saudi Arabia is pumping it out at its maximum rate and flooding the markets with as much as they can? Why don't they just keep it and sell it later for more expensive prices? They have more oil than most other people, so this would benefit them more than most other people, right? No, it's a predetermined, deliberate massacre, and it's coming soon to a Bitcoin miner near you. Currently, and unfortunately, the world needs oil to function, so the only people who can make the price so cheap are those sucking it out of the ground and selling it. Saudi Arabia are deliberately making the price low. Why do they do this, making it so unprofitable for everybody? Well, Saudi Arabia knows that Canada, the US, and Brazilian shale producers have a much higher point at which their economies of scale are able to benefit them. Therefore, if the Saudis can take the price low enough for long enough, not only can they make it unprofitable for their competitors, they can make their whole business model uneconomical, therefore capturing all that market share. And in commodities, market share is king. Most oil companies need to sell some of what they produce in order to fund their operations. And so the lower the price of oil, the more of it they're going to have to sell to meet their costs. Similar to oil producers, many Bitcoin miners have to sell some of what they produce in order to fund their operations. The halving is a 50% cut in their rewards of 12.5 Bitcoin to 6.25 Bitcoin for every block mined, but their production costs stay the same. Therefore, in order to meet their costs, they have to sell a higher proportion of what they produce. This increases the supply side pressure even as the price falls. For Bitcoin miners, 95% of their costs are electricity, so this is generally a fixed price that won't change in the short term. Therefore, we can say A 50% reduction in their rewards is the equivalent of a 100% increase in their cost of production per unit. That means if you're not currently able to produce the Bitcoin you're mining at 100% profit or more, post-halving, you're going to be not making a profit, you're going to be left with expensive, worthless equipment, and furthermore, you won't have any capital flows to upgrade to that efficient machines that can mine Bitcoin on par with the large efficient producers. What do you think Bitcoin miners are going to do with this opportunity to completely wipe out a third of their competitors? What would you do if you were the world's largest Bitcoin miner and had an opportunity like this to destroy your competition? And what does all of this mean for investors? Well, investors like to buy when it's low and sell when it's high, don't we all? So they're going to look at this market, and if they're not sophisticated, they'll think, well, they're producing it for this price now, which is soon to double, so their costs will double, so they'll probably sell it for a lot more, therefore it'll be cheaper to buy it now than later. But slightly more sophisticated investors might look at this event of the halving and not automatically assume that it's going to make the prices go up, certainly not in the immediate term. They might see, as we've talked about, there being an increase in supply pressure. They might even see that this will lead to a capitulation event. Many miners are locked into mining contracts or pools, which contract them to keep mining and producing Bitcoin regardless of the price. So they'll keep doing it even at a loss until such times as they go bankrupt and their collateral or their contracts are liquidated. This would potentially increase the supply pressure even more. So slightly more sophisticated investors might be waiting until after this capitulation event, or alternatively, they'll be looking for signs that we're in a confirmed uptrend if this event doesn't happen. So jumping straight in before the halving isn't necessarily what all investors are going to do. You may have heard the phrase, the halving has been priced in. Now, pricing things in is entirely possible with shares that have dividends or any assets. Future price moves can to a certain degree be priced in. But to apply this phrase to a capitulation event doesn't make perfect sense. How do we spot this opportunity? Well, I find it helpful to imagine miners as two groups: efficient miners on the latest equipment and inefficient miners on soon-to-be outdated machines. Efficient miners using the latest technology account for around 62% of all Bitcoin currently being created, the other 38% belonging to the inefficient crowd. Assuming an average electricity rate from both groups, we can see that if the price of Bitcoin is $10,000, then everybody is making a profit. But as the price approaches $8,500 and lower, these inefficient miners start to go bankrupt. As the price approaches their break-even point, they'll be forced to sell more and more and more Bitcoin in order to cover their costs. If prices persist at this level or lower, then many inefficient miners are going to go bust. Shortly afterwards, the sums will get easier, the difficulty rating will be adjusted down, and the business of mining Bitcoin will become very profitable again. But the real kicker for miners who've just gone bust is that as this difficulty rating is reduced, the prices of these efficient Bitcoin mining machines is going to start going up again. This will make it prohibitively expensive for victims of the halving, without any capital inflows to upgrade to these better machines. There have been 2 Bitcoin halvings before. On both occasions, miners experienced extreme financial pain. In the lead up to the halving, the price increased slightly. Subsequently, it took a bit of a dump. Both times, it subsequently went on to set new all-time highs. So, that tells us there are excellent entry prices for investors who want to hold long term, and amazing opportunities for traders who are able to go both long and short when appropriate. But questions persist. Has the coronavirus caused price action to liquidate miners already, and that capitulation has been camouflaged in the terrible drops we saw there last month? Or does decentralized finance offer miners a different opportunity other than simply to sell Bitcoin that might keep them in the game for a little longer? Indeed, are there other methods of mitigation now that future contracts exist that would allow inefficient miners to hedge against their own positions? On that note, large oil companies often hedge against their own positions. But when future contract prices are already so low, they can't short in order to mitigate. So even if they don't go bankrupt today, their headstones are still being carved out for next summer. Is it possible that something similar could happen to the futures contracts of Bitcoin? These are all things I'd love to hear your thoughts on, and I'll cover them in the next video, where I'll also be looking at charts and pointing out where I think these excellent entry points are for long-term investors. I'll also be showing you some of the indicators that traders will be using to see if and when this capitulation event happens. And I'll make a prediction of my own. Remember, none of this was financial advice, and I'm not a financial advisor. I'm Jamie, and this was Tradespotting.